Okay, I have hit the record button and we have officially started another Option Profit Formula Success Academy Q&A call. It's been a while. It's great to talk to you all here on a live call tonight. Our agenda for the night, what we'll do is cover a few admin notes. I'll cover, I think, 2 or 3 questions that were submitted prior to the call. We'll go over the general market, which everybody's anticipating. I know we'll have open Q&A for those on the call tonight if you have any other lingering questions. And then we'll have some parting thoughts as usual, what I call final takeaways. Tonight, a few minutes ago, I was asking if you all could hear Peter. Peter's my co-host here. If you're not familiar with Peter, Peter was the person I did a couple of podcasts with. If you all listen to those podcasts, you will be familiar with Peter. Peter, now that we have the recording on, can you go ahead and say hi again?
Hey everyone, it's great to be here, and hopefully I don't screw this up for Travis tonight.
You'll do fine. I think I have your website still pulled up. Peter and his buddy James started a website called JP Cashflow. Is James and Peter, jpcashflow.com. So you can go ahead and check that out. He's a member of this program also. Don't think I just brought in some stranger. We are, I don't know, I'm very particular about who I work with. So Peter's a member of the program, student. He went through the ranks, studied really hard, doing really well now. Just a great guy all around. He's going to be helping me out here in the next few weeks. The reason I asked him to come on this call today is because I am going on maternity leave here in a few weeks. So Peter's going to step in, answer some questions for me in the members area when I can't get to it, maybe even do another live call himself. So my wife is our third son. We're having another boy, and she's due here in a couple of weeks. So we just had an appointment today. So she's due in a couple of weeks. So when the baby comes, I will still be around. But if any chance I can't get to my computer, things like that, you never know with babies. They have their own agenda. Then Peter will step in for me. So that's why I have him on a call tonight. Next admin note. Well, thanks. Oh, real quick, I just noticed the comments everybody's coming in. Thank you all so much for the congratulations. I really appreciate it. Scott just has 3 exclamation marks. Oh yeah, thanks, Brian. All
Hopefully that's not towards me, Scott.
Yeah, right. Yeah, right. Is it directed towards me or Peter? I'll try to. Matter of fact, up underneath the replay for tonight's call, I'll have the link to the other 2 calls I did with Peter, like little podcasts where we were just talking and things like that. There's another one. I don't want to give Peter a hard time. There's another one that no one knows about. We're just waiting for that one to be posted, but when it's posted, we'll let you all know.
Yeah, and that's right. That one's the so you guys will like that because that was a call in that I got to actually interview Travis. So I got to ask him some really good questions that I think everyone will enjoy. So once I get that posted, Travis will let you know where to go and the whole 9 yards. So I'm working on it.
All right, pal. I'll keep on you about it in a friendly way. All right. Next admin note here. And the same admin note we had before. My heart. Trust me. I love these calls. I really want to do them more, but I have to stick to what we said last year that unless we have another bear market, we won't hold too many live Q&A calls. The reason we're having this one now is because you'll see in a moment we're in stage 3.5 of 4 of a market crash. So just in case this is a market crash, we want to start early and start preparing our minds and things like that. So if this is a bear market, then we'll keep holding the calls. As promised, I promise everybody, I'll walk them through the bear market, step by step. As long as you're an active student, you're an active student. If you're a new student, join within the last year or someone enrolled in trade school. Now, if this downturn is not a bear market, then what I'll do is just walk you through the uptrend. It'll just be a pullback. It'll be an uptrend. I'll walk you through the short uptrend afterwards because it's usually pretty quick. The uptrends happen. And then you're back on your own after that because I don't want to handicap anyone. And that's part of the focus I changed about a year and a half ago. I realized that some of the things I was doing was handicapping people or wasn't my goal here. I had a coach, and he helped me realize that my goal is to facilitate your growth as a trader. And so I had to change a few things to make you more independent and not, what does Travis think about the market? What is your view on the market? It doesn't matter what my view is. My goal now is to help you develop your own strength in looking at the market and being confident in your own decision making. And so that we can get to the point where we see the same thing and you see it on your own without having to wait for me to give you training on what the market is doing. Okay. Now, it's a question that I just received from a new student. I put in the admin notes. He just joined and he wanted to know how long the course was and how much time had to be committed to it during the day. And then he ended it with, but it doesn't matter as I would give it everything I have. And I put this here because I'm like, that is an absolute great attitude to start off with, to say, you know what, no matter what, it doesn't matter. I'm going to give it everything. I have no doubt this person will succeed. But to answer this question, the course is as long as you want to make it. You can get through most of the core training in about 8 weeks, but you have a year's access to the memories area. And so what we always encourage people to do is please download the training as you consume it, because you have a year's access to the memories area. Unless you join trade school, you don't need to join trade school because everything's downloadable. But the majority of students do stay because they like staying up to date on what's going on and joining all the live calls and getting the replays and all that. Now, if you can commit, it varies. Some people can commit, 15 minutes a day. Some people can commit 2 hours a day. Some people 1 hour a day. Some people are only weekend warriors. They only can really consume it. It varies across each student. So I don't have any cookie cutter answer for you. I redesigned the program several years ago to make it self-learning. You learn at your own pace that's comfortable for you. The only one thing I don't do is open up everything all at once, because it is really, really bad for learning. Consumption and retention are two different things. You'll consume everything, but you won't learn it. You'll miss a ton. And Peter knows that for sure, because he always gives me a hard time because he asked a question a long time ago. And I was like, well, Peter, that was in the training. And it was also part of your homework. And he was like, I got you. I'll go back. And so he doesn't let me forget that. I'm like, well, yeah, it's my job to make sure that you all don't miss anything. And that's why we have that time release training. So I hope that answered that question. All right, so let's move on here for the first Q&A somebody submitted here. All right, moving on. Credit spreads. Someone wanted to know, do I use Marketclub for entering spread trades? If so, could I go over this a little bit? Absolutely. Let's see. The way I want to answer this one is, all right, for those who went through the money management myths here, okay, who remembers the part about profit catalyst? And if you remember the part about profit catalyst, type in, or profit catalyst is the thing that it's the main thing that causes a trade to be profitable. So a profit catalyst is the main thing that causes a trade to be profitable. So what's the profit catalyst of a credit spread trade? So while I wait for you to type that in, I'll go ahead and tell you the first thing I do if I'm using Marketclub for credit spreads is I look at the general market. So looking at Marketclub here, let's just come to the top options tab because it's quicker for me. I first see what the general market is doing, because the general market will always influence my trades, 85, 90%, give or take, or 75 to 85. It doesn't matter. A large majority of your stocks will be influenced, or a large majority of any stock traded in the market will be influenced by the big three, S&P, Dow, NASDAQ. Whatever they're doing generally influences other stocks. It's not 100%. It's not neck and neck. But when the market is down pretty heavy on one day, you can look on CNBC and you can see all this red that most of the other stocks are down also. So, stocks just don't trade in a bubble. They are influenced, by this large basket of stocks here. So that's what I first do. I look at the general market because the general market will affect my trades. Okay, so Brian has it right. Great, Brian. Thanks so much. Brian says time decay. Awesome. I love that when somebody gets it right. Okay, so you're right. Time decay is the profit catalyst of a credit spread trade. And to capture time decay, you have to make sure the option you sold stays out of the money. All right. So going back here, if we were to sell this option right here, this 195, whether it's a cover call, credit spread, it doesn't matter. Selling options. We're selling the profit catalyst of a selling strategy is time decay. Credit spreads fall up under selling strategies. Well, uh, the credit spreads fall up under the selling strategies. And so the profit catalyst is time decay. So if we sell this, we want to make sure, we hope that SPY stays out of this price area, 195. So if it's a call, we want to make sure that SPY in the next, 9 days doesn't go above 195. If it was a put and we sold this 193 put, we would want to make sure that SPY doesn't fall in price to 193. Okay, so what you're trying to do is capture time decay, and you want the option you sold to stay out of the money. So whether I'm using Marketclub, my free tools my broker gives me, you always start with the profit catalyst. Then once you know your profit catalyst, what makes this strategy profitable is time decay. You figure out the best way to put on a trade. And so you could use support and resistance. You could come here, you say, okay, the profit catalyst is time decay. Support for the SPY, or let's do SPY, that's what we're looking at the S&P 500. So we look at SPY, and then what we can do is draw support down here. We can say, well, here's support, the most recent support for SPY. I can sell a credit spread around this area, and in hopes that SPY doesn't fall. Or if you're bullish, you could come above here and say, well, here's resistance way up here. Let me sell a spread at that area. Okay, and then you would like the stock to stay outside of that price area. So essentially you're targeting a price area, and that's how I use Marketclub. So I logged in Marketclub. Here on my home screen, it says weekly trade triangles, and so I'll put up most of those stocks. Say we have APEI. It just triggered for weekly trade triangle. Now look at the trade triangle it just triggered for. Look at the trend score for those who use Marketclub. Would you place a credit spread on this stock, either bullish or bearish? Just put what kind of credit spread. Yes, you would, and then what kind, bullish or bearish, or no, you wouldn't. Go ahead and type in your answer. Say APEI. Would you trade a credit spread on this? Okay, Timothy says no. Thank you, John. John has it right. Lenny, Marcus, everybody's putting no. Great. I'm the same way. I wouldn't trade it. John had it. It says mixed signals. All right. Because you have the long-term trend here, the monthly is saying downward. And then you have the intermediate and short-term trend saying up. It's mixed signals. I don't know which way it's going to go, up or down. So, I wouldn't place a credit spread on it. You could do something. I don't teach advanced strategies. So I wouldn't place a credit spread because I wouldn't know, do I place it bullish or bearish? I could say bullish because it just traded for weekly. However, the trade triangle say the long-term trend is down. So maybe this is just a short-term rally here and then it's going to start falling back down again. I wouldn't want that. So for me, I wouldn't do it. I don't like inconsistency. It's like schizophrenia. So I can't get a full gauge on it. I wouldn't place it. Same thing with Buffalo Wild Wings. Okay, we can look at this. For time's sake, I'll speed through this. Buffalo Wild Wings. This is a stock I'm actually targeting right now to trade a credit spread on. Everything's in unison. Long-term, mid-term, short-term, and it just triggered for weekly. The one thing I don't like, which I said a few minutes ago, is we looked at the general market. What is the general market doing? The general market is down right now or flat. So it's like neutral bearish, okay? It's in a downward trend. I know that will affect my stocks, and I'll get to why I'm thinking about a bullish spread on this one here in a second. But so this is one I'm triggering. One I'm targeting. Recently triggered for a monthly, weekly. So what I'm doing is essentially summing this all up is I'm targeting a price point. The price point that Marketclub is telling me I can target is around the 199 level. And it's telling me that in the short term, this stock will most likely go up. So this is the price area I target. I sell a credit spread, give or take around this area or right below it. And then again, and when you're selling using credit spreads, you hope that stock stays away from the option you sold. And using this price area I'm targeting, then that's what I do. But again, you don't need Marketclub. You can literally use support resistance or the free tools your broker uses. But that's my long-winded answer as to how I would use Marketclub with credit spreads. It's not really Marketclub. I don't want you to get focused so much on Marketclub. I want you to think of the strategies going back to the beginning. We look at the general market. What is the general market doing? We think about profit catalyst, what makes the strategy profitable? Because when you figure that out, then you can say, based on what the general market is doing, I'm going to use strategies that have a profit catalyst that aligns with the general market. Right now, the general market is neutral bearish and is going flat. So there's some inconsistency there. So my profit catalyst, I'm like, okay, I don't want full bullish strategies. I don't want full bearish strategies. Right now, I want strategies that are either have a non-directional approach to them, meaning that I'll be on both sides of the market because it looks like the market can't make up its mind. So I might sell a bullish credit spread on Buffalo Wild Wings, but I have a bearish credit spread on SPY or something like that. So I'm on both sides of the market. And when the market makes up its mind, then, we'll see. So I'll be on both sides of the market. Or I traded a strangle recently on SPY. Since the market has these large swings recently, I don't know if it's going up or down. I traded strangles, and I don't think I have the strangle strategy in the members area. It was a bonus strategy I taught a few years ago, but pretty much you buy both a call and a put, and you don't really care which way the market goes. You'll make money either way. But there's some trickiness to it because the market really has to move to compensate for what you paid, for the option. Because you look here, if we bought this call option here for 300, and then we came over here and bought this put option for 324. Well, that call option has to have at least, let's say SPY went up. And I mean, you look at it, it has to have 100% return on investment just to make up the price you pay for the put. How often do you get 100 baggers? I get them every now and then, but I don't get them enough to bank my whole future on this strategy. So there's some challenges with those. So I did what they call a strangle. I just came a little bit further out. And I was banking that these large price swings that happened in the last few days would be consistent. And then I'd profit, which I wound up doing. And then also, I traded a put option on DIA. I wasn't going to get into my trades until later, but I'll go ahead and do it now. I traded a put option on DIA about maybe a week ago. Per the Marketclub blueprint, it was satisfied at the time, and it was all reds, I think negative 100. So I bought a put option on Dow. So Marketclub template said to me I could buy put options, so I bought a put option on Dow, on the Dow DI, and that's still open, currently down, I think maybe $100, give or take. So that's kind of the approach I'm taking right now. I was going to cover all that when we got to the big three, but I just revealed it right now. All right. So I'm looking.
Trav,
yeah, go ahead.
Just look at, is it Nile? You asked a question about a bull put spread on Buffalo Wild Wings.
Okay, let's see. Would it be better to sell a credit spread on Buffalo Wild Wings when the SPY is near a support area? You know what? That's a good question. I guess it would depend on your own particular trade plan. My trade plan, what I do is look at the general market. Credit spreads, direction is not the profit catalyst, time decay is. So I look at the general market to see what it's doing, and it's neutral bearish. And I also look at Buffalo Wild Wings, and I see that it has strength on its own. So I'm keeping the general market in my back of my mind. It's going down. Make no mistake about it. The general market is going down right now. So I keep that in the back of my mind that could influence this trade. But also I'm looking at the strength of the stock and looking at it, I'm like, well, it's kind of doing its own thing. And since the profit catalyst is not price movement, if it was price movement, I would absolutely not trade this because it's inconsistent with what the general market is doing. But remember, the profit catalyst is time decay. So you can do selling strategies pretty much in any market, and especially if the market is kind of indecision right now, it's okay. But to hedge or to protect myself, I'm also on the other side of the market too. Remember, I'm on the bearish side of the market too. So this is just, I'm on both sides of the market. That's what the market is doing. It's kind of indecisive right now. It's going up and down. So I'm on both sides right now. More leaning towards the bearish for now. But, this Buffalo Wild Wings was the only one bullish strategy I was considering making just because of the strength of the stock. So a good question. So yeah, when he said bull put spread, that's what I was thinking about doing, Nile. It was a bull put spread. I wasn't thinking about doing a bearish, anything like that. It's called a bull put spread. Maybe I confused everybody when I was actually just going over the option chains. But yeah, for Buffalo Wild Wings, it'd be a bull put spread. How far you come out, that goes in a trade plan, what you like. I love getting my profit quick, but I don't like how they don't like this 9 days here. It doesn't give you enough room really for it doesn't give you a lot of room for error. That's what I don't like, so that's the trade-off. So for me, I might risk a tiny bit here, spread out my risk and income both September and October, put the bulk of my money on October if I could find one with a decent open interest, or even come out here to December. I wouldn't come any further than 100 because I hate waiting so many months. It's like agonizing waiting for your profit to come in. All right, so big three here. So let's move on here to the next question here. This is from Karen, I believe, my Aussie student. She wanted to know, do I have any views on this dead cat bounce that the media keeps talking about? They talk about it here in the U.S. too, not just Australia. Dead cat bounce, I don't know where they came up with the term, but a dead cat bounce is essentially what they're trying to say is this pullback that we're having right now is a dead cat bounce, meaning that it's just going to be a normal pullback and then the market will recover. It's just going to be a pullback and then the market will recover. Instead of essentially a dead cat bounce. It's like a fake out. That's the way I call them. It's just like a fake out. All right. So I'll share my thoughts on that here in a second when I address the next question based on the big three. And this, I think it was Joe or no, Ed. All right. So when do we conclude that it's not a pullback like July 2011? And I have July 2011. I think I pulled that up here. So let's pull up 10-year daily chart here. So July 2011 is circled here. So let me zoom in a little bit. So let's look what happened in July 2011. Somewhat the same thing had happened here. 7 crossed down through 30, 200 started pointing down. Prices traded well below the 200-day moving average for a long time, and then they eventually recovered. This was a really stinky time to trade in the market. I mean, you had the market, falling in price, and then not after it fell in price, it kind of went sideways for a while. So you look here from August 2011 to maybe here, October. That's 2 months of this kind of back and forth large price swings. So for a directional trader, you're frustrated because you're sitting on your hands for 2 months not finding any trades. Option sellers love these type of markets, but the buying strategies kind of are rendered useless. Especially if you're like, well, the 200 is down, I can trade puts. You're buying puts, and then the market goes back up on you. You're like, ah. So it's really tough trading those in the fold, those cusp on the transition periods. It's really tough trading them because you can't get a full gauge in the market. There's not enough time to really establish a good trend. All right, so that's July 2011. So he said our chart seemed to look very similar to that year. Then it took off again as a bull market. I ask this because one of the components that I have often seen before a real fall is incredible optimism. People are still pouring money in. That's the optimism. People are still pouring money in despite the crash. Right now, many, it seems like, are suggesting the collapse, and that bothers me because it doesn't fit the typical pre-fall attitude surrounding the market. And I'm like, you just took a page like right out of my diary, because I agree 100% with you. And in all of my videos, I try to say that is that in every market crash that I've experienced, you see that delusional optimism, that extreme optimism. When the market pulls back like it is right now, but you hear it in the newspapers, like buy stocks now, they're really cheap. Like people aren't scared. Like people just look at it and shrug it off and like, it's no big deal. And they get excited, they buy more. That's what you usually see. And also I'm in the middle of reading these two books, Rational Exuberance. I don't think I really can get through. It's kind of dry for me. But in this book and also Random Walk Down Wall Street, they both cover the previous market crashes, all the way from the tulip bulb, craze to Black Monday, market crash of the 2000s, 80s. They cover all these market crashes. Both of these books cover it. And they all talk about that extreme optimism. And I'm like, that's my experience too. It's like when I see those market crashes, you see that optimism. So I am leaning towards no, this right now is not going to be a bear market because that optimism is not here. However, I always add that caveat. That's what I think. The market doesn't care what I think. That's why I trade what I see, not what I think I'm going to see. I already walked you through what I see and how I'm trading it. Trading what I see. If I traded how I think, I don't think this is a bear market, I'd be buying like long-term call options or bullish strategies and just kind of wait for the market to sort itself out and wait for me to look like a genius. But I'm not going to do that, because when you trade what you think, you get too emotionally caught up in your thoughts, and you miss the obvious. And the obvious, like people right here, if they thought that back when, matter of fact, I drew a two-year trend line for everybody on the last live call we had. It wasn't a webinar, but we a 2-year trend line. I even put the video on YouTube. It was back in June. I always say way before everybody else got on a market crash bandwagon. I'm like, well, market's most likely going to fall right now. Now, if we thought that it's just going to be a quick pullback and the market's going to resume again, we would have kept trading put options, and then we would have missed the obvious, that the market kept going down and kept going down. It just went down pretty heavy. So on this book here, that Random Walk Down Wall Street, this guy, and it's interesting because he he disagrees kind of with our style of trading. And on page 154 of this book, I wrote the quote today. It says, "No one has consistently outperformed the placebo of a buy and hold strategy. Technical methods cannot be used to make useful investment strategies. This is the fundamental conclusion of the random walk theory." Pretty much he's saying that using Marketclub can't help us make profit. Using chart patterns, it's useless. This is what they're saying. And that buy and hold works, right? And it's okay reading people that have different opinions of you. And when I encounter people like that, I don't argue with them. I don't try to persuade them to see things my way. That's a lot of work. So what my mentor taught me to do is, you let them keep their opinion, you keep your real world results. And more in your face saying is, look, you keep your opinion, I'll keep the cash in my bank, because you're not going to tell me that the profit I'm making is a lie. That's a losing argument for you, right? When I traded the strangle on SPY the other day, it was like an 80% return on investment in one day. I'm like, you can't tell me that's a lie. I was like, you keep your opinion, I keep my results. So, but I agree with somewhat what he said, because that's why I'm not married to what I think. We're not trying to predict the market. We're not saying, hey, the market is not going to crash, it's going to be a pullback. We're not doing that. That's dangerous. What we're doing is we're trading what we see. When we trade what we see, we can never be wrong. We're 100% correct in what we see right now. Now, trading what you think gives you a 50-50 chance of succeeding. Trading what you see is it's like ebb and flow. It's like a dance partner. You're dancing with your partner. You're a team. You're working together. One of you not thinking one thing and others not thinking another, thinking, I just screwed that up. How about this? This is a better way of saying it. I've seen it. When couples grow apart, in a marriage, what happens? Usually, sometimes they get divorced, or either they stay unhappily married. I don't want to be unhappy. Okay, I'm the happiest when me and my partner are of one mind. I am the happiest when I am of one mind with the market. I am trading what I see. I am incredibly unhappy and frustrated when I trade what I think. If I think, this short-term pullback that happened in June was just a short-term pullback and I buy call options, then when the market went down like this, we grew apart. I would have lost money, and that's why I don't like doing it. I kind of trade what I see. Does that make sense? I feel like I'm rambling. Is that making sense with anybody? We're not predicting anything. We're ebb and flow. We're like dance partners. We're dancing with the market. Please let me know if that's making any kind of sense. And Nile says the book was informative, but he disagrees with his conclusion. Yeah. I haven't finished the book, so I don't know what the conclusion is. But sometimes you just have to not agree or disagree, but kind of just let it marinate in your head. Because what happens when that's why I said I don't argue with people, because it's when you disagree, you literally shut your brain off from learning anything new. And so this person could have some good viewpoints. So if you don't agree or disagree, you kind of just, okay, I hear you, and let it marinate. And then sometimes you can pull out some pearls of wisdom to help, either solidify what you view and your beliefs, or either help you become a better person. So, sometimes you just kind of have to let it marinate. But I don't know. I haven't fully finished reading that. But I always laugh when I read these books and they're like, oh, technical stuff doesn't work. And I'm like, man, I don't know. My results differ. So, you keep your opinion. I'll keep my results. Anyway, All right, so going back to trading, what I see, everybody's putting in, yeah, it makes sense. Okay, great. So, all right, so let's go. Let me show you exactly what I think and what we see. All right, I showed you what I think. Let's show you what we see. First, we are in stage 3.5 of a market crash. I've already emailed you that. Where's the handout? Here's the handout that's in the memories area. That training is in the bonus section, and it's a 4 stages of a market crash. Okay, so bonus section, 4 stages of market crash. So about 5 trainings down. And the one thing I want to really give you a caveat here is just because we have these stages, it does not mean it's going to be a market crash. These stages are just here to help you stay grounded and help you to trade what you see. So stage 1, coming back to this handout, stage 1 is really our red flag. Okay, it alerts us to pay attention to the market price movement. That was back in June when I drew that trend line. It's really normal price movement, but you start paying attention. There's no need to be alarmed. Everything looks normal, but because we're using a certain combination of moving averages, that it alerts us that things may not be as normal as they seem. Okay, stage 2 is essentially confirmation of stage 1. This gives us extra assurance that prices may indeed be on their way to lower territory. Stage 3 is at this point, there is reason to be alarmed. Between stage 2 and 3, or either at stage 3, is where you start. Is either getting out of some of your bullish positions or adding some bearish positions. You start protecting your cash, and that's kind of what I did. I was in some bullish trades. I start closing out some of them. The ones that look like they may be teetering on losing money. Some of them I walked away break even. Then I added on some bearish positions, and I recorded a video. It kind of was on both sides of the market, both credit spreads, bullish and bearish, kind of the stance I still have. By the time you get to stage 4, that's where I'm leaning more towards puts. So all of my trades, I'm more bearish than I am bullish. I have a put option, I have the strangles, and I have bearish credit spreads, and I'm only thinking of opening maybe one bullish trade, and that's it. Okay, but stage 4 is usually around the time the media starts reporting, hey, it's a market crash, the public is still aware. It's never right around this time. It's always like a month or two late. Okay, and then people are just, it's too late. We've been alerted since back June. If you paid attention, even on a live call, I walk you through it. I'm like, well, we've been paying attention since June, so it shouldn't, this downfall that just happened recently, it should not have been a surprise to you. Absolutely should not have been a surprise to you, because we covered that on our last call we had, plus what you learned in the training. All right, so that's what I see. Now, also looking at a 2-year chart. So let's pull up a 2-year chart. Okay, what's the 2-year trend here? I'm looking at the time. I will answer it for you. The 2-year trend here, we're looking at an S&P 500 is up. Okay, long-term 2-year trend is up. Let's scale down to the 1 year. What are you seeing in 1 year? It gives appearance of up, but if you draw our trend line here from where prices were a year ago to where they are now, it's gone nowhere. So for the 1 year, so the 2-year trend is up, 1 year trend is flat. It's gone nowhere. It's had a lot of volatility, but it's gone nowhere. And then we pull up a 3-month chart, and what do you see? Pretty much flat to down. Okay, so what you would like is all three to be in alignment, up, up, and up. That's the best situation to invest in. If you don't see that, then you can feel free to sit out. It's no shame in sitting out in cash. Cash is a position. I won't harp on that anymore, but it's a position, and sometimes the most profitable position, because while other people are losing money here, you're not. You're break even, you're in cash, and then when the market recovers and either keeps going down or goes back up, they're just making back what they lost. But when you start profiting, it's all profit. Okay. And we've already talked about how losing money is an unfair formula, because it takes you more money. I'm looking at my chart. I keep beside my computer because I never want to forget this. If I lose, 35% of my money, I need 53.9% just to get back to break even. So you need more to get back to just where you started. So, you're sitting in cash, you're break even. These people, they lose money. I'm like, they're way behind you, both in time and money. Okay, so never be afraid to sit in cash. So there's inconsistency, what I see here. That's why I said I'm kind of approaching it. I'm mostly in cash. Marketclub did give me a signal way back like last week to trade puts. I did that, one or two. I didn't go guns blazing and open like 10 trades. I'm like, no, I don't trust it. We're still in a bull market. Even though we're trading put options, we're still in the bull market. The template is satisfied. I'm going to follow the template. I'm also going to be smart about it. I'm like, I'm trading puts in a bull market, an overall bull market. Remember that 2-year chart I just showed you. So this may be a transition period. The market may be turning over to go in a bear market. I don't know. That's why I only open 1 or 2 trades. So I'm mostly in cash, and any other trades I'm opening from this point on are kind of being that non-directional approach, either trading both sides of the market with a selling strategy, or if I'm doing directional strategy, a put option. All right, so that's what I see in the market, how I'm trading. Real quick, I think this is the point where we have an open Q&A. I've been talking for a while. Let me take a sip of water. I'll review my notes to see if I had any other points I wanted to cover for you. If you have any additional questions, go ahead and type them in, and Peter will collect them for me. So give me 1 sec here. All right, so I think that's it. That was the last question, Peter?
That was.
All right, so I will leave you all with my final takeaways for tonight. Sorry we ran over, but I hope you enjoyed all the Q&A. I will break up the replay. I'll probably put the bulk of the call on one video and then break up the open Q&A to another video, just so people don't have to feel like they have to watch an hour and a 15-minute video. But my final takeaways for the night is based on, I'm thinking of writing a short either book or training on how successful traders think, taking all the things I've learned over the years and how people view the market differently. Okay, so here's a lesson I shared with a student earlier this week, and I'm sharing it with you because I'm like, other people could be in the same boat, and I want to make sure you all make the same distinction. I was checking with the student, and I was saying, hey, you haven't logged in for a while. I haven't heard from you. What's going on? Did life get in the way? I always get worried when people don't log in for a while. And he was like, well, no, I'm doing fine. I've been reading books, sharpening, my trading and things like that, and he says, I want to, get the rest of what's in the training program to memory. And this is going back to what my mentor taught me about how theory doesn't put money in your pocket and implementation does and things like that. And the distinction I want you to make is he helped me see that you don't sharpen your trading by reading. Reading is a big rally of self-educators. It's what they're used to. And they will load you down with more content, more books. You need to read this book. You need to read this book. And what happens is, first, all right, let me stop there. You don't sharpen your trading by reading. You sharpen your trading by implementing what you learn. And so when you read, you consume, you consume, you consume, you consume. So right now, since you're rolling this program, if you're just new, I'd rather you not spend your time reading books when you've invested in a course that has proven results. It just doesn't make any sense. So there's enough information in this memories area here for if you spent several hours a day, it would take you at least a year probably to get through everything that's here. There's enough to keep you busy, even if, and that includes going through it 2 to 3 times. All right. So I prefer that you hold off on reading books until you implement what's in the memories area, you start having success. Then, yeah, go read books to kind of supplement learning and things like that. But, what they say, don't put the cart before the horse. Wait till you get results first, okay? Another distinction I want you to make is that you learn, you implement, you tweak according to results, you rinse and repeat. The distinction that self-educators and unsuccessful traders never make is they learn, and they feel like they're getting ahead, and they're not. It's a false sense of progress. It doesn't get you anywhere. And how do I know that? Because the results don't lie. Does it add any more money to your bank account? It doesn't. And that's the distinction I want you to make between successful traders. Successful traders realize that it's one thing to read a book for supplemental information to kind of enhance what you already know. It's another thing to already be successful. All right. So if you're already successful and you're reading a book, that's different. You're just kind of reinforcing what you already know. But if you're unsuccessful yet and you haven't proven results in your reading, no, you haven't made the distinction of a successful trader, because a successful trader learns to implement what he's already have in his brain. You implement, you tweak according to results, and you rinse and repeat. So don't get caught in that false sense of progress. That's why I'm always encouraging people, don't just consume the videos. Get out there, paper trade. Peter was saying it earlier when someone asked a question about a credit spread. He was like, get out there, paper trade. He didn't say go review the training or read a book on it. He was like, no, get out there and implement, because that's where you really learn. And I think that's one of the bigger reasons why Peter is successful, like a lot of the other students. So let's see. Look, somebody put in one comment here. Roger just put, hold up. Well, did I miss a couple of comments, Peter, before we go?
Yeah, one from Nile. I just wanted to mention something. You were the first person I came across when I started this journey. I now profitably trade futures, and after going through various services, I continue to respect your style the most. The thing I like about you the most is how transparent you are. You make trading seem a lot more real than almost everyone else out there in this space, if you know what I mean. Thank you.
Wow, that was great. I really appreciate that comment, Nile. Really, I'm gonna have to copy that and post it up. Yeah, that's a good. Yeah.
That's Nile. You know, that's how I feel. I've taken other courses, and I've taken them just to see what they're like, but they just don't compare to Travis's teaching style.
Oh, well, I appreciate it. Definitely. I have to stop here before my head gets too big and my wife comes home to deflate my ego. So we'll end on that note. But Roger just piggybacked on a point I was making. He said when you're driving around, you kind of listen to the trainings to reinforce, while you're busy implementing the strategies back at the ranch. So that's actually a good technique, Roger. Listen to the training, while you're driving around, working out, things like that. Not that you want to hear my voice 24/7, but you listen to it. And then when you're back home or on your computer, you can actually implement what you learned. So great point, Roger. I appreciate it. So you all take care. Thank you so much for everybody to stay faithfully to the end. I really appreciate it. You all take care, and we'll have this replay out to you within about 48 hours after the call. So Peter, just stay on for a few minutes afterwards, and I'll stop this record now. So you all take care, and I'll talk to you soon. All right, bye-bye.